Welcome to your Financial Legacy podcast. I am your host, Maria Ellis. On every episode, I will bring you my perspective and the perspective of my guest on financial planning and estate planning topics. Here on the Financial Legacy podcast, we're changing lives one person at a time. Last week, we talked about 1031 exchanges, and today we are going to be providing you with information about Delaware statutory trusts that we could use in terms of replacement properties on your 1031 exchanges. Today we have special guest, Gary Callaghan, Senior VP and External Wholesaler at Inland, as well as Rob, who was with us last week. Welcome, Gary and Rob. Welcome to our show.
Thank you for having me.
Gary, so you're on the spotlight. Tell us a little bit about your company, Inland, and how long have you been a Senior VP doing external wholesaler for Inland Securities Corporation?
Sure. It's a great question. It's my favorite question anytime I'm asked, because like many and hundreds of thousands of American business success story, Inland is such that. And I say that because Inland was founded in 1968 by 4 public school teachers, literally in the last day of school in the teacher's lounge, because they were earning a salary of $7,700 a year back in 1968. And they were trying to figure out over the next 10 weeks while the kids were out of school, how are they going to supplement their income? And one of our founders suggested that they dabble in real estate. They thought it was a plausible idea. They took some of their own personal savings. They reached out to family, friends, and even colleagues within the school they worked. And they raised about $4,000. They bought an empty lot in Itasca, Illinois. They developed a 2-family ground-up development investment property, sold it about 19 months later for double what they paid for, and obviously paid back all of their investors, if you will. And that singular real estate experience, today, 52 years later, about to be our 53rd year, we are the 8th largest privately held commercial real estate company in the country. We're headquartered out of Oak Brook, Illinois, with over 1,400 employees, and we are truly a real estate operating company versus a real estate syndicating company, and I always make that distinction. So I'm very proud of that, and it's a great culture that has been set by our 4 founders who are still actively involved in the organization today. And I've been with them since 2014. I was recruited to join Inland and be a 1031 consultant for the company.
Well, thank you. That's very encouraging to know that people could build fortunes if you make the decision to move forward and take some action. You briefly mentioned about syndication versus operating, and I think that for some of the audience, I would like you to clarify a little bit on that, or elaborate a little bit more.
Sure. So from our direct real estate operating experience, we do everything at Inland, whether it's development, construction, leasing, marketing, accounting, tax preparation, risk management, maintenance, asset management. So versus a syndicator, usually you'll partner with a real estate operating company. You'll syndicate securities or deals that investors can invest in, but do you really have the day-to-day hands-on approach to managing those real estate assets? And to me and to us at the organization, we believe that being a real estate operating entity gives us an advantage in terms of quality control of the work you're doing on behalf of investors, as well as the expense control, because the minute you start farming out those services, it only drives up higher costs. And then sometimes you can also lose that quality control. So it's just who we are. And I think that it makes a big difference when investors have to make that consideration, if they can identify whether I'm a part of a syndicated deal or whether with a real estate operating entity.
Yeah, I think it really makes a big difference in terms of really the overall bottom line for the investor, because as an operator, like you were saying earlier, you have so much more control in terms of anywhere from lease increases to cost reduction to renewals. I mean, day-to-day operation, what's going on in the marketplace as well, right? Just due to the activity. So
Yeah,
that I think that that's a great differentiating factor, because one of the questions that I wanted to ask you further down the line was, what makes you different? And I think that you have certainly partially answered that, and we could elaborate a little more on that as we continue our conversation.
sure.
So we know that you guys have over 570 properties really located throughout the United States, and it represents, over almost $8 billion on assets under management, right? As of December 2019, that's my data. I imagine you'll probably update those numbers as in our conversation today. So you really are, as you were saying, the 8th largest, so you're really one of the leaders in that particular field. So tell us a little bit more about the properties. I know you have a very diverse portfolio, correct?
We do. So to kind of update those numbers, Inland Real Estate Group, as the parent company, if you will, we have close to $20 billion of assets under management, real property. But the division that I work for, which is the Inland Private Capital Group, that focuses on, which I think was the topic you had with Rob last week about Delaware Statutory Trust.
Correct.
Yeah, we just eclipsed in that division alone about $9 billion of total assets, with over 500,000, I'll call them shareholders, but really investors that we are responsible to be, as I continuously repeat, in the marketplace, to be good stewards of investors' capital. And really what differentiates us at Inland in that respect, in Inland Private Capital, is the fact that we were the petitioning company that worked with the IRS to have this alternative solution inside of a 1031 exchange under the structure of a Delaware statutory trust. And that was authorized and legitimized by the IRS in 2004. And for the last now 17 years, we have been the market leader in bringing Delaware statutory trust solutions for 1031 prospective exchangers as a consideration of their replacement property when going through a 1031 exchange. So
you really were at the very initial process, and you're saying you were one of the creators, so the change in force that took place in Washington to generate this?
That's
or
correct.
Were there others as well in the industry that participated in that process? Because that's kind of massive. It takes time, takes money.
It took us 3 years. We sent our legal team down in 2001, and over the course of the 3-year period, the IRS finally said, yes, there should be an alternative replacement property solution. And I'll call it, you can either be an active landlord or you can be a passive landlord. And the statutory trust gives the passivity characteristic versus the active landlord. And to that point, the reason why we petition the IRS is the major driver of that of our petitioning was the demography. We've got over 10,000 people today turning 65 years of age in this country. And if you think about it, in order to effect successfully a 1031 exchange, you must relinquish a property and then you must replace with a property. Well, that's great, and you get all the 1031 benefits of that tax deferral, but you're still, as I like to say, carrying around that little red toolbox, dealing with the toilets, tenants, taxes, trash, and termites. And maybe somebody in their 60s, 65, 70s might just be exhausted from that and want to get out and change their lifestyle. And for that reason alone, the Delaware Statutory Trust, as we like to say, instead of the terrible T's, it provides the positive T's, whether it's travel, time, teeing off, and tennis, meaning your lifestyle has been improved without the encumbrance of managing a real estate asset with 3 a.m. phone calls where the water heater broke, or you get rent controls that are affecting your ability to grow rents and increase your income as a landlord. So that was the real driving force, was the demography issue in our country.
It really is sort of a great social benefit as well for people in that age group. So not only you're providing peace of mind, but it's just, I think, overall a great product. last week when we were talking with Rob, we precisely were talking about who is our ideal client, and those, as you were saying, and both of you were saying, it is somebody who has had a property for a number of years, have a large capital gains, are afraid of selling because of the high taxes. So the DSTs as an alternative solution offers a great opportunity for people to sort of get rid of a lot of their obligations and just being able to enjoy their, what I call golden years, you know.
Correct.
So I think that is very good. So
Maria, if I could just add something at
yes,
this juncture.
please go right ahead.
So just to kind of piggyback on what was said, Gary had mentioned good stewardship of these programs. What I have here is something called the Mountain Dell report. Mountain Dell tracks active sponsors and DST programs that are out there. So there are a lot to choose from. But those of you who know me know that the cornerstone of my practice is my military background, and I'm a straight shooter. I'm very big on quality. And guess really hard who's at the top of this list here when it comes to market share. It's me saying it, not Gary. It's Inland. So they are a juggernaut in the space. Conservative underwriting, under-promising versus over-delivering. I'm very big on that. I'm always telling the Inland story, as Gary and his team know. So that's very, very important. And it piggybacks on what I had mentioned last week. So I just want to say, Gary, you guys are crushing it. You're consistently at the top of that list. I see it as a registered rep. You guys are doing a great job.
Yep. Thanks,
Yeah,
Rob.
that is really, thank you for bringing that up, Rob. I think that's very important, especially as people start thinking about what are some of the alternatives. Not everybody is the same, right? So it is important to recognize the strengths and weaknesses of the particular products. And one of those, Gary, will be like, tell us a little bit about, what's a weighted average analyzed return in some of your products. What has been and how have you been able to achieve that? And what has been the holding period? What have been some of the risks, benefits, and so on and so forth?
Sure. So I would say, first and foremost, I'll always like to answer questions very directly, but I am going to put a disclaimer in answering your question directly. And I'm going to do that because I want you to understand what our investment thesis is when we are considering structuring a Delaware statutory trust for a prospective 1031 exchanger. And that investment thesis is the fact that we recognize that a 1031 exchanger has already hit that proverbial home run with their real estate position. It's highly appreciated. They worked hard to get that asset to a level now that it could be a consideration for a 1031 exchange. So when they're seeking replacement property, and especially if we're talking about the demography pool that we were just illustrating, you then have to say, is it really fair for us at Inland to try to hit another home run for those investors versus delivering dependable monthly income and preservation of their principal, if you will, in that Delaware statutory trust structure? So that's really our investment thesis going in, is to be conservative, to preserve principal and deliver dependable monthly income. So now to answer your question directly, we've averaged about an 8% return for our investors annually. And the average hold time, because you are illiquid, just like if you hold real estate, it's not necessarily a tradable asset. Our average illiquidity time period is about 5.5 years as of the close of 2020.
Good. I think that's an important point in terms of, again, providing education for our clients, especially the clients in that demographic area, people over 60s, they have accumulated capital appreciation. And at this point, what they really want is to be able to have that security or that peace of mind that that although there are risks associated with, like in any investments, at least this portion is managed in a way that it is suited to the risk averse, profile for people at that age, because they don't really have another opportunity they don't have the years ahead like a younger person would, right?
Correct.
To make it up. So, and last week, Rob and I, we were chatting about it, and we were saying, yeah, that's a very important consideration because other providers might come up with larger numbers, but there are risks involved in that. Tell us a little bit more about it, Rob.
Absolutely. So we touched upon it last week, and I mentioned that obviously rate of return always comes up. Clients are always looking to get a little more juice from the orange, so to speak. But I always caution them, that has a very high price tag. And Delaware statutory trusts are certainly not a vehicle you want to chase return. You want, again, good stewardship, conservative underwriting. So I'll have great conversations and I'll talk about companies like Inland that do just that. And a week later, a client will pop up and say, well, I Googled, I found something, it's paying 8.5%. How come you didn't tell me about that? Okay, who are they? How long have they been doing this? The number comes from somewhere. They're underestimating taxes, they're overestimating occupancy, they don't have the necessary reserves on hand. Something is happening there. So it's highly, highly risky, and I always recommend against it. So you want quality in your corner. You can't do a better job than that than within.
Thank you, Rob. So Gary, if we were to look at one of your investments as an example, tell us a little bit about the mix of those. Like, for instance, will there be some multiple family properties, real estate, industrial, even student housing? Tell us a little bit about the composition and why do you think that that's good, and why is it structured that way?
Yeah, so right now our investment committee and our board, when we're seeking out where we believe the next cycle or sectors of commercial real estate should be acquired and structured into a Delaware statutory trust, is what we believe, I like to call them short lease durated real estate assets sectors. Things like you mentioned multifamily, they have 1-year leases. We also like self-storage because they have 30-day or monthly leases. We like assisted living, more independent private assisted living, not nursing homes with medical care, if you will. And we also like the student housing market because that takes on similar characteristics to the multifamily or Class A apartment building lease structures annualized. And the reason for that is obviously we've been pumping a lot of money from the Fed into the money supply. Eventually, inflation is going to rear. If it not already is, it is definitely going to rear itself, and you need to have hedges. And real estate is a great hedge against inflationary conditions. But more importantly, if you have short lease durations, it puts you in a position to increase rents to hedge that inflationary effect, which preserves the property value, but more importantly, it preserves hopefully the return for those investors in those asset classes. And that's really the driving force of our thinking, is identifying sectors of commercial real estate that have short lease durations in order to offset either rising interest rates or the effect of the inflationary effects.
And I think that the fact that there are different buckets, some that are, like you say, monthly, some are, yearly renewals, at which point in time you get to increase your rates. I think that's, you're able to count with that income stream, with those various income streams, to be able to make decisions. So when you make those decisions, is a lot of the property that you manage, is that mostly acquired, where you come, you acquire, you renovate, you upgrade and move forward, or do you actually build do any construction?
Well, in the arena of, there's other areas of our company where we do through private equity structures some ground up development, but inside the Inland Private Capital, more specifically to the Delaware Statutory Trust,
right,
we're seeking out the institutional high quality real estate assets that are occupied, that are stabilized, and are cash flowing. And that's really what that description of the asset class inside of a Delaware statutory trust. And I think Rob would concur with me because I know Rob, in working with clients and prospective exchangers, you still have to achieve diversification. Right. And the benefit of the Delaware statutory trust is that you can diversify by having multiple sectors with your exchange. I could put a little into multifamily, a little into student housing, or a little into self-storage, but I can also then get geographical diversification because our properties, we're not just buying our properties in the state of Illinois where we're headquartered. We actually are in every state except for 4 in this country. So we really have a geographical footprint to achieve geographical diversification as well as call it sector diversification. And that really is done and spearheaded by 1031 experts like Rob that strives, and he does that by the ethos and the code of being a financial advisor. But certainly when you're dealing with 1031 exchange money, the more you can diversify, the better your clients. We call it the swan. You want to sleep well at night.
That's right. That's right. And I'm glad that you brought up that point, because diversification in any portfolio, whether it's a 1031 exchange or your, regular brokerage account or your retirement account, you need to diversify both, not only in terms of sectors but also geographically. So, and I
Agreed.
think that that's one of the areas that we really enjoy on the products that you generate. Geographically, I know that your area is New York, New Jersey, Connecticut, correct? So how many people do you have? How many advisors do you currently have in that area?
Yes, my responsibility at Inland is to cover New Jersey, Metro, New York, Long Island, and the state of Connecticut. There are 3 very significant markets in the 1031 exchange or Delaware Statutory Trust in this country. One of them is the outlying territory that I just described. The other is Northern California and Southern California. And so for that matter, I probably have had access to market and promote and educate well over 10,000 financial advisors. And that continues to grow as we continue to expand our education for the financial advising world. And not just them as well. I know Rob works in a similar fashion. This is about education. The
Right.
Delaware Statutory Trust Marketplace is about somewhere about a $1 billion marketplace. And so therefore, a lot of financial advisors don't ask their clients when they're onboarding a new client or their existing clients, do you own commercial real estate? They really only focus on their residential real estate. So
Right.
it takes people like Rob and myself to go out and talk to accountants, real estate attorneys, estate planning attorneys, and even real estate brokers, because they're really the most people that own commercial real estate. And whether they're interested in buying it or selling it, they don't call their financial advisor. And thereby it requires us to get the information, the education about the flexibility, the convenience, and expeditious nature that the character traits that the Delaware Statutory Trust brings as a potential property replacement solution inside of a 1031 exchange.
Yeah, and I think a lot of that has to do with the educational aspects of it, because people sort of get used to looking at mutual funds and REITs and other things that are sort of readily to be picked out of the shelf versus really our jobs as financial advisors is to understand the client's needs and be able to offer them the best possible portfolio that meet those needs. So educating people, both clients as well as, advisors, whether it's your CPA or your attorney or your financial advisor, I think is critical.
Maria, excuse
go
me,
ahead, Rob.
I'll add to that. Yeah, it very much is an education all day, every day. And, Gary had mentioned before, there was a revenue ruling that created this structure in 2004. So it's not the newest thing around. It's been around for 17 years now. But the vast majority of these advisors who should know about it, like real estate attorneys, like CPAs, like commercial brokers, they just don't know it's an option. So by people like Gary and myself going out there and educating the public, we're empowering them. We're helping them journey through their 1031 exchange with greater confidence and having more options available. So it's all about the education. And it's one of the reasons it's one of the reasons I built a brand and a practice in this space, and I'm so laser focused on this, is because it's so underserved.
I agree. Thank you. Gary, is there anything else? Go ahead.
I'm sorry for interrupting, but I was going to say it all boils down to the investor, the individual that owns the real estate. If their attorney, their accountant, their real estate professional is unaware of A, just the 1031 tax code on its own, and B, what options are available as replacement property solutions, they're doing a disservice to their clients. So the more knowledge they have, the more value they can bring to their clients. So the client, most importantly, can make an informed decision that fits their needs and objectives for their future when doing a 1031 exchange.
Yeah, and it's huge because the savings on capital gain taxes, I mean, that's
Yeah,
that is a very large number that would make a big difference, not only in terms of saving taxes, but also having more money to invest in the DSTs that will return, obviously, a greater amount of overall interest coming back to you, right? So it's a win-win situation. You save money and you make a little bit more because you have more money to invest. In the last conversation that we had with Rob, I give an example of somebody who's has sold their building, their commercial building, and they had $2 million proceeds. If he had now done a 1031 exchange, he would have had to pay taxes on that, and that's almost $800,000 that you could have invested, right, and be able to afford to go on a cruise around the world or whatever you like to use those funds for. So yeah, at the end of the day is really understanding the client and be able to be the best possible advisor for that client. And also in the last meeting, we talked about the importance of having a team of people. And in this meeting also we touched on that, your attorney, your CPA, people that can help the client meet the overall short, medium, and long-term needs. Thank you for this. I just was curious, and I asked Rob a similar question last week. If you had not chosen this career, what would have been the second best choice for you, Gary?
Oh boy. Well, my family, my family had always been in insurance, aunts, uncles, my father, my sister. And so I said, when I graduated school, I got recruited by a very large insurance company, AIG.
Mm-hmm.
And 2 years doing that, I was not lighting my flame like it was lighting my family's. And I had an opportunity to come into the wholesaling career. There's only about 5,500 wholesalers in the country as a career. So it is a very, very finite sized professional career, but right. I can't tell you how rewarding it is and enjoyable it is to work. And more importantly, when you're bringing financial solutions to financial advisors like Rob, whether it's solely focused on 1031 exchanges or in other arenas, whether it be annuities or mutual funds, you're dealing with people's money. And whether somebody invests $1,000 or somebody invests $1 billion, to me, I feel like it's important that they understand what they're investing in. And again, as repeated, to be good stewards of that investor's capital. And so I find it rewarding when people are putting trust and confidence in us in order to deliver and meet their financial objectives. And over now the last, I'm dating myself now, 31 years of doing this, it's still just as rewarding as the first day I started back in 1990.
Yeah, because really we're dealing with people, right? So, and we want the best for people that we serve, because it is by helping them that our business also grows.
Right. So I think to answer your real question, and like Rob, I am former military. I probably would have stayed in and put an entire career in the military. I would not have been a fighter jet pilot like Rob, because I'm not as smart as he is, but I certainly enjoyed serving the country for the 6 years that I did, and probably would have, if I didn't do this, would have stayed in the military and put a career in it. So.
Well, thank you again to both of you for making time to spend time with us. Also, I'd like to thank for people who are tuning in to the Financial Legacy podcast. Here with me, Maria Ellis, and my guest, Gary Galligan from England, and Rob, our 1031 expert. So how best you can reduce your overall taxes, capital gain taxes, and to find replacement properties for your 1031 exchanges, please contact us. So give us again your contact information, Rob.
The best way to reach me is via my website. It's easy to remember, 1031rob.com. It has all my contact information. In the Zoom world, I typically do this. I have a QR code where you can grab all my information, which won't help our guests when this is posted up. But 1031rob.com is the best place to reach me.
And of course, you can reach Gary through Rob. So if you want to connect with us, please connect with us at financiallegacy.live. for a complimentary consultation. I thank you both. Namaste. Have a great day.
Thank you, Maria.
Maria, thank you,
Bye-bye.
Gary.
My pleasure. Take care, everyone.
Bye, guys.
Bye.
In providing answers, neither Maria Ellis nor the Financial Legacy podcast and guest speakers are acting as certified financial planners, advisors, certified financial analysts, CPAs, economists, accountants, or lawyers. Neither Maria Ellis or the Financial Legacy podcast and guest speakers make any recommendations as to any specific securities or investments. All content is for informational and general purposes only and does not constitute as financial or legal advice. You should consult your own tax, legal, and financial advisors regarding your particular situation. Neither Maria Ellis nor Financial Legacy podcast and guest speakers accept any responsibility for any loss that may arise from accessing or reliance from any information in this podcast. And to the extent permitted by law, we exclude all liabilities for any loss or damages derived directly or indirectly arising from the use of the information.